In September of 2008, Wall Street had one of the scariest weeks in modern history. This was not just a normal stock market crash. This was a full-blown financial panic. Some of the biggest financial institutions in the world were falling apart. Banks stopped trusting each other. Companies were struggling to borrow money, and the people in charge were worried the entire system could break. One major investment bank disappeared. One of the biggest insurance companies in the world needed an emergency rescue. A money market fund, something people thought was almost as safe as cash, suddenly was not safe anymore. And in just a few days, Wall Street went from nervous to terrified. This is the story of the week Wall Street almost died. To understand how it got this bad, we have to go back to the housing boom. In the early 2000s, home prices were rising fast. Banks were lending aggressively. Mortgage companies were giving loans to people who probably should not have qualified. And almost everyone seemed to believe the same thing. Housing prices cannot fall everywhere at once. That belief became one of the biggest mistakes in modern finance. Because banks did not just keep these mortgages. They bundled them together. Then they repackaged them. Then they sold them to investors all over the world. On paper, this looked smart. The risk was supposed to be spread around. But in reality, the risk was not gone. It was just hidden. It was chopped up, renamed, insured, and buried inside banks, hedge funds, pension funds, and insurance companies. And as long as housing prices kept going up, the machine kept working. But once housing prices started falling, everything changed. Borrowers started defaulting. Mortgage investments started losing value. Banks started questioning each other. And suddenly, nobody knew who was holding the bad debt. By 2008, the warning signs were everywhere. Bear Stearns had already collapsed earlier that year. Fannie Mae and Freddie Mac had been taken over by the government. Banks were holding on to cash. Investors were nervous, and everyone was asking the same question. Who falls next? Then came Lehman Brothers. Lehman was not some tiny company. It was one of the most famous investment banks on Wall Street. It had been around for more than 150 years. It had survived wars, depressions, recessions, and market crashes. But in 2008, Lehman had a huge problem. It was loaded with toxic mortgage assets, and people were losing confidence in the firm fast. In finance, confidence is everything. A bank can survive losses. It can survive bad headlines. It can even survive a rough year. But once lenders and investors think you might not make it, they pull away. And when everyone pulls away at the same time, even a giant can collapse. That is exactly what happened to Lehman. Over one weekend in September, government officials and Wall Street executives tried to save it. They needed a buyer. They needed a deal. They needed more time. But they did not have time. Potential buyers did not want to take on Lehman's losses without government help. The government did not want to provide the same kind of support it had used before. And by Monday morning, September 15th, 2008, Lehman Brothers filed for bankruptcy. It was the largest bankruptcy in American history. And the shock was instant. Lehman was the moment everyone realized nobody was fully in control. Because if Lehman could fail, who was safe? Banks stopped trusting each other. Investors rushed into safer assets. Companies started worrying about whether they could still borrow money. And the basic plumbing of the financial system started to clog. Then, before anyone could even process Lehman, another giant was already in trouble. AIG, as American International Group, was one of the biggest insurance companies in the world. To most people, AIG sounded like a boring insurance company. But inside AIG was a massive financial risk. AIG had sold credit default swaps. Basically, it had promised to pay out if certain mortgage-related investments went bad. For years, this looked like easy money. AIG collected fees. Housing prices kept rising. Everything seemed fine. But when mortgage investments started collapsing, AIG suddenly needed huge amounts of cash. And it did not have enough. That created a nightmare. Because if AIG collapsed, it would not just hurt AIG. It could hurt all the banks and financial firms that had depended on AIG for protection. So now the government was staring at another disaster. Lehman failed on Monday. By Tuesday, AIG needed a rescue. That is how fast everything was moving. Wall Street was not dealing with one fire. It was dealing with fires spreading everywhere. But the scariest part of that week was what happened next. A money market fund broke the buck. That sounds boring, but it was a huge deal. Most people thought money market funds were almost like cash. Safe, stable, boring. You put $1 in and you expect to get $1 back. But after Lehman failed, one major money market fund had losses tied to Lehman debt, and it could no longer keep its share price at $1. In plain English, a supposedly safe cash-like investment had lost money, and investors panicked. Money started rushing out of money market funds. This was not an old-fashioned bank run with people standing outside a bank. This was a modern bank run. Money moved through computers, wires, and institutions. And it moved fast. As money market funds faced withdrawals, they had to sell assets. A lot of those assets were connected to short-term loans that companies use every day. That market is called commercial paper. Companies use it for payroll, inventory, and daily expenses. So when that market started freezing, the crisis jumped from Wall Street into the real economy. That is what made 2008 so scary. It was not just about bankers losing money. It was about whether normal companies could keep operating. Could businesses borrow? Could they pay workers? Could the economy keep moving? At that point, the crisis was bigger than Lehman, bigger than AIG, bigger than Wall Street. It had become a threat to the entire financial system, and every choice was bad. Save a company, and people say you are rewarding failure. Let a company fail, and the panic could spread. Rescue AIG, and people ask why Lehman was allowed to die. Do nothing, and you risk something even worse. There were no clean options, only dangerous ones. That is why officials eventually went to Congress. They wanted emergency power to stabilize the system. That became TARP, the Troubled Asset Relief Program. The government would use hundreds of billions of dollars to stabilize the financial system. And to a lot of Americans, it looked like a bailout for Wall Street. And honestly, that anger made sense. People had watched banks make huge profits during the boom. Then, when the bets went bad, ordinary taxpayers were told the system had to be saved. That is when the phrase "too big to fail" became burned into American politics. Because the message felt brutal. If you are small and you fail, that is your problem. But if you are huge and connected enough, your failure becomes everyone's problem. That was the moral disaster of 2008. The rescue may have prevented something worse, but it also showed how fragile and unfair the system had become. Millions of people lost jobs, families lost homes, retirement accounts were crushed, and trust in banks, regulators, politicians, and financial experts collapsed. The crisis did not just change markets, it changed how people saw the entire economy. For years, Americans had been told the financial system was smart, advanced, and self-correcting. But in 2008, that same system had to be rescued from itself. And here is the strangest part. Most of the people at the center of the crisis were not trying to destroy anything. They thought they were managing risk. They thought housing prices could not fall everywhere at once. They thought complex models could measure danger. They thought the system could handle the shock. But it could not. Because the danger was not in one place. It was everywhere. Inside mortgages, inside securities, inside derivatives, inside banks, inside money market funds, inside insurance contracts, and inside the assumptions that everyone trusted. That is why September 2008 was so terrifying. It showed that modern finance had become so connected that one failure could trigger another, and another, and another, like dominoes. Except the dominoes were banks, insurers, lenders, funds, and corporations. And nobody knew where the chain reaction would stop. The lesson of 2008 is not just that banks can fail. It is that systems can become fragile while still looking strong. They can seem stable because everyone believes they are stable. Until suddenly, they do not. And once that belief disappears, even the biggest institutions in the world can fall in days. That is why September 2008 is still one of the most important weeks in modern history. It was the week Wall Street discovered that confidence was not permanent. Risk was not contained, and the system was not nearly as safe as it looked. This was the week Wall Street almost died.